It's Friday, 27th of February, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, the great cocoa price boom and bust. But first, I'm happily joined by Group Chief Economist Neil Shearing and by special guest Julian Evans-Pritchard, who is our head of China economics. Hi, Neil. Hi, Julian.
Hi, David.
Hi, David.
It's that glorious time in the cycle when I get to use the word quinquennial because this coming Thursday is the start of the National People's Congress in Beijing. But it's also publication of some of the key policy priorities from the latest five-year plan, the 15th plan. Julian, how excited are you about this?
It's great. It's like Christmas for China watchers. Yeah, I mean, obviously, this is a particularly special NPC because of the five-year plan, as you say. So not only will we get all the sort of standard economic targets for the upcoming year, but we'll also get a better steer on the sort of medium-term priorities for the leadership in China.
Yeah, and to be clear, so Thursday morning is the opening of the session. It begins with the release of what are called these work reports. And that's where we're going to get the sort of the information about the near-term policy priorities, but also, as you say, these medium-term goals around this five-year plan. It's easy, isn't it, to be cynical about these sorts of events because there's lots of ceremony, there's lots of party rhetoric, but they can be important, can't they, in terms of signaling the overall policy direction. So what is the expectation for this coming week in terms of what we think the leadership might announce?
I mean, they're definitely very useful. The Communist Party, the leadership in China, are not particularly good at communicating their policy objectives, particularly to sort of a wider global audience. And so this is a rare kind of opportunity for them and for us to sort of get a better sense of what their various goals are. As you say, on next Thursday, on 5th of March, Premier Li Qiang will deliver the government's work report, which will contain the GDP target for this year, the inflation targets for employment growth, the unemployment rate, etc. Now, a lot of the focus tends to be on the GDP target. Understandably, the expectation there is that it might be nudged down a little bit. So last year it was around 5%. This year, the expectation is that they'll set a target range of between 4.5% to 5%. But I think people tend to focus a bit too much on the GDP targets. Often the perception is that the target, if they set a high target, that will therefore encourage them to do more policy stimulus to achieve that target. But in practice, that doesn't really appear to be the case. So we have our own alternative to the GDP data, which tracks how the economy is actually performing. And that suggests that growth last year, even though on paper hit the target of 5%, in reality, it seems to have been closer to around 3%. So I think for us, the sort of headline growth target is maybe not so important. More important, I think, is the actual policy signals that are coming out from the government work report. And I think that's particularly important for fiscal policy because in addition to the work report, we also get the Ministry of Finance publishes their annual budget. And fiscal policy tends to be quite rigid in that it doesn't tend to be adjusted mid-year very often. So usually once they set the fiscal stance for the year, that's basically set in stone. Now, last year, they actually loosened fiscal policy quite substantially. So they increased the headline deficit target to 4% of GDP from 3% previously. And on top of that, they also increased special bond issuance outside of the main budget as well. Now, this year, most signs are that they are not planning to increase the headline deficit target any further. They may potentially do a little bit off budget, but the big picture, I think, is that they're not going to be doing the same degree of fiscal easing as we saw last year. Fiscal policy will remain supportive. It just won't be loosened quite as much. And the reason for that really is that the deficit is already very, very large. It's already more than 8% of GDP on a sort of broad basis. And I think they are concerned about the sort of medium-term fiscal risks of running such a large deficit indefinitely.
I think some of the points you make there, Julian, get to the heart of, I know this is Christmas for China watchers, and I don't want to ruin Christmas, but it does get to the heart of one of the challenges here, I think, which is that these events are useful, as you say, in terms of signaling the priorities of the leadership. And there's clearly some value in that. But I do think there's a tendency sometimes to extrapolate from that. This is going to be the outcome. It signals priorities, but it doesn't necessarily tell us much or indeed everything about the outcomes that flow from that. And I was looking back. I think this is the 6th 5-year plan that I can remember in my kind of professional career as an economist coming out of China. And if you look back at what the priorities were in each of those 5-year plans, and then the actual outcomes, I mean, some of them were really substantial and significant, but others passed and kind of faded without trace. So I think we should get things in a bit of context here. It's really useful in terms of signaling priorities, particularly, and we'll come on to talk about this, the attitudes or priorities around economic policy. But we should be careful about over-extrapolating or over-interpreting those priorities and extrapolating them into firm outcomes. I think sometimes there's a danger that a lot of the analysis around 5-year plans strays a bit too far in that direction.
All that being said, there does seem to be heightened expectations that we might get some kind of a shift this year. As you say, Neil, I mean, plans of the past have spoken about the need to shift the economic model to drive what they call this rebalancing process. But we have, I mean, Julian, we have heard in terms of the mood music, there does seem to be a greater acceptance of the need to address some of these deep-seated issues with China's economic model. I mean, to what extent do you think the rhetoric, the communications that we're going to get in the coming week are going to meet those expectations?
It does feel like there's been a little bit of a shift. Just thinking back to the previous 5-year plan, the one that just concluded, what really stood out from that plan was the focus on the manufacturing sector and on making sure that the manufacturing share of GDP did not decline any further. And I think in the 5 years since that plan was published, that policy focus has definitely been borne out in the data and in many of the policies that the government has pursued in terms of industrial policy. So, I do think that these plans provide some useful signals. And I do think based on the proposals for the upcoming 5-year plan that were published late last year, there are some signs of a bit of a shift towards a greater focus on consumption. So for the first time, there's talk of having an explicit target in the plan to increase the consumption share of GDP, for example. Now, having said that, there's still very much a focus in the plan as well on industrial policy, on innovation, on particularly national security and sort of addressing some of the vulnerabilities that China has in terms of its dependence on imports of foreign technology. So there's definitely still very much a bit of a tension between those two goals. So I think the key thing that we're going to be looking for next week and over the course of the NPC, we may not get the full 5-year plan on the first day itself, but over the course of the sort of 7 or 8 days or so, we should get most of the details. What we will be looking for is sort of how are they going to address this tension? One thing to watch maybe is, do they put an explicit numeric target on boosting the consumption share of GDP? Because I think that would be a stronger signal than just saying, oh, we want a higher consumption share of GDP. And on the other side of the equation, do they acknowledge that they need to allow the manufacturing share of the economy to diminish? So far, they've simply said that they want to maintain an appropriate level in terms of the manufacturing share of GDP, but it's not clear what that really means in practice. So we're going to have to see kind of how they balance these competing goals.
If these signs that you're looking for do come to fruition next week, and I should add also, we're going to have press conferences, aren't we? Annual press conferences from some leading economic ministries and from the Premier himself. But if we do get these signals, what does that mean in terms of China's rebalancing process? I mean, China's saving rate has fallen and the investment share of GDP has come down a little bit, but really at a snail's pace. So what's the outlook if things go the way that we're expecting?
So as you say, I mean, there has been a little bit of a rebalancing in terms of the investment share of GDP coming down, the consumption share of GDP rising. But I would say that that's very much been a passive rebalancing driven by structural forces like population aging. If anything, government policies have actually delayed that rebalancing and held it back. So what I think needs to change is that we need government policies that are actually proactively encouraging rebalancing. And there are some signs that they might take some steps in that direction. But my expectation is that given the competing priorities, that this is going to be quite a gradual embrace of some of those rebalancing priorities. So I do think that the consumption share of GDP will probably continue to rise over the next 5-year period, and probably a bit faster than over the previous 5 years. But I don't think we should expect a sort of step change in the speed of rebalancing. I think it's going to be quite a gradual and drawn out process.
So what are the implications of rebalancing?
But I guess the sort of the key challenge that the Chinese economy is facing at the moment, because of the imbalances that it has, the imbalance between excessive supply and weak demand, is basically deflation, and in particular overcapacity in the manufacturing sector that's leading to goods price deflation. And so one of the key consequences of rebalancing, at least over the medium term, is to bring the growth rate of the supply side of the economy back in line with the demand side, and bring those two things together so that you no longer have an additional buildup of overcapacity, and some of the existing overcapacity gets absorbed. And eventually then inflation should recover, and that should put the economy on a healthier footing. Now, I think that process will probably take some time. If you go back to 2015, for example, when they had a previous round of efforts to try to boost inflation, get the economy out of factory gate deflation, it was successful eventually, but it took a while, and it in particular took quite substantial demand side stimulus. And that seems to be what's lacking at the moment. As I said earlier, there's not much indication that they're planning to do substantial demand side stimulus over the next year or so. And so if you're trying to bring these imbalances back in line through more structural reforms through the supply side of the economy, that's going to be more challenging. And so I think we're likely to see some of these imbalances persist for a while, even if they do start to gradually improve and you get inflation starting to recover over the medium term.
And the other part of that is, as I mentioned, the saving rate, which has come down a bit, but as I say, still a very high level on a global basis. How do you bring that down, which I guess is a flip side of saying how do you get households to consume more?
Well, I think there are a number of things that the government can do. One option would be to increase redistribution. It's pretty striking that for a country that's nominally socialist, China has one of the sort of highest levels of income inequality after transfers, certainly among developed economies, or compared to developed economies, even higher than the US, for example. So China basically does not do much redistribution. Redistributing income from high-income households, low-income households would bring down the savings rate, just because lower-income households have a higher propensity to spend. The other reason for the high savings rate is concerns about future retirement needs, healthcare needs, because of the sort of relatively feeble social safety net that China has. So one way to address that would be to make pension entitlements and medical healthcare entitlements much more generous. Not only would that boost spending immediately, but it would also help to bring down the savings rate as households feel more secure and feel that the government is taking care of their future needs. So these are all options. I think the challenge is that, as I said, China already has a quite precarious fiscal position, or at least it's already running a large deficit. And so the government doesn't feel as if it has a lot of fiscal room to become a lot more generous in terms of welfare support. And so I think a lot of this will have to be funded through reallocating spending from other areas, and in particular, reallocating spending away from investment. At the moment, the government spends around 4% of GDP on investment, just at the sort of state government level. A lot of that could be redirected towards households, and that would help to essentially fund the rebalancing without widening the deficit.
But there's a tension there as well, isn't there? Because you can't address industrial overcapacity while at the same time giving households some surety about the social safety net, because addressing overcapacity will inevitably result in some job losses. So increasing that concern about unemployment.
That's a good point. And I do think that over the next few years, what's likely to happen is that some parts of the economy will see improvement because of this rebalancing. But in other areas, particularly producers of investment goods, people who work in those sectors, who work in the construction sector, they're going to continue to face pressure. Shifting spending from investment towards consumption, it improves the situation in some areas. It will support demand for consumer goods, for example, so reduce overcapacity of consumer goods, but actually make overcapacity worse in other parts of the economy. So it's certainly not a sort of a quick fix, if you will. But over the medium term, if you bring investment down, then the supply side of the economy will grow a bit more slowly, and eventually some of those imbalances will ease.
Neil, everything Julian's saying, in the very least, it doesn't sound like we're going to get some sort of big bang policy package that's suddenly going to shift China's economy away from investment towards consumption. And Julian has outlined the sort of the domestic challenges, but this is very much a global story, isn't it? So frame what's happening, the imbalances in China. What is the global context?
One aspect of this, of course, is that for every surplus, there must be a deficit somewhere. And often there's a tendency, I think, to frame this as a uniquely Chinese problem, that there's China's surplus that's a problem for the rest of the world. But of course, the flip side of that is a large deficit, principally in the US. So it's not just a problem for the rest of the world. There's some benefits to the rest of the world too. That US deficit, of course, reflects the fact that American households, American firms too, are able to consume more than they produce. So I don't think that, the kind of Trumpian framing of the view that China's surplus is China winning is not quite right. In fact, it's not right at all. And indeed, there are some benefits to Americans, particularly US households, in the form of additional consumption they otherwise wouldn't be able to undertake as a result of this Chinese surplus. Nonetheless, there are, I think, occasions when we should be concerned about global imbalances in trade positions. The first, the most obvious, is that for every surplus, there must be a deficit. And for every deficit, that country must accumulate some external liabilities. So China's busy accumulating vast amounts of external assets. The US is accumulating vast amounts of external liabilities, and that requires these deficit countries to continue to maintain the confidence of foreign investors. And very often, that accumulation of external liabilities can cause the coincident development of financial stresses and strains and vulnerabilities too. So we should be concerned about imbalances because of the accumulation of external liabilities in some cases and what that means for financial stability. The second reason, I think, is that, of course, the counterpart to China's large trade surplus is the sheer dominance of its manufacturing sector. And that's affecting not just the US, but also increasingly traditional manufacturers like Germany. And that can be a concern at a macro level if you think that those sectors are being squeezed, being hollowed out by Chinese competition, because very often productivity growth is faster in the manufacturing sector and in the production sector than it is in the services sector. And so that can have an implication potentially for long-run growth in some of these economies that are now facing extreme competition from China. And I think the third reason why we might want to be concerned about global imbalances, and this is not necessarily anything you'll find in the academic textbooks, but increasingly I think is on the radar of policymakers, is it's about national security. And do Western countries, and the US in particular, want to find themselves in a position whereby China has become so dominant in some areas of manufacturing production and so competitive that the US and its allies now essentially have become dependent upon China for the supplies of critical goods that have national security implications, drones, medical equipment, dual-use goods that have purposes in military and civilian life, critical minerals. We've already seen spats over critical minerals, haven't we? But the batteries, green technology, this plays out in a lot of different areas. And of course, the Economics 101 has nothing to say about this from an imbalances perspective, but I think that has real-life policy implications. And indeed, I think to some extent is arguably the bigger concern for governments at this stage rather than the pure imbalances point.
Oh, there's a lot to unpack there, isn't there? But I mean, one question I have is around, for all that you've said about the benefits of China's manufacturing heft, but also the risk that it's creating. Julian, we've got this non-consensus forecast, don't we, that China's trade surplus is just going to increase in the coming few years. I think most people think it's going to flatline maybe. The IMF saying perhaps it's going to narrow a bit. We think it's actually going to expand. What does that mean, Neil? What does that mean in terms of the world's capacity to absorb this surplus?
I think one point that's worth just keeping in mind is that if you look at the sheer size of China's surplus relative to China's GDP, it's actually smaller now than was the case in, say, the mid-2000s in the run-up to the global financial crisis. So back then, China ran a current account surplus of between 7 and actually I think it peaked at just under 9% of GDP in 2007. Now it's close to 4% of GDP. So it's smaller as a share of its own GDP. But the point, of course, is that China's economy has become much larger in that period. So it's now, as a share of global GDP, China's current account surplus is almost back to where it was in 2007. And of course, the trade surplus itself is even larger as a share of global GDP than was the case in 2006, 2007. So if China's surplus increases from here, then at a global level, as a share of global GDP, it will become an even bigger drain on global demand and require a larger offset in deficit somewhere else. The immediate implication of that, of course, is that while both sides, both the US and China, are trying to talk up stability in the relationship, particularly ahead of Trump's visit to Beijing, I think the underlying trade tensions are not going away. These imbalances are structural in nature. They're certainly not fixed by tariffs. And yeah, well, I think we're going to be on a track for the next few months where both sides are playing nice and talking up stability and trying to project some positive outcomes from this visit, and indeed perhaps lay the groundwork for a visit by Xi to Washington later this year or early next year. The underlying strains of the relationship, particularly around trade, I don't think are going away.
Julian, let me ask you, we were talking about rebalancing. We didn't talk about the exchange rate. China's impact on the global economy. Neil mentioned there what China is doing to German industry. Friedrich Merz was in Beijing just this week, asking or calling on China to allow the renminbi to appreciate further. Can you talk a bit about the role of the renminbi in driving these domestic imbalances, in driving the external imbalances? How undervalued is it? And the appetite to let it strengthen from where it is?
So I think the exchange rate is an obvious channel through which to try to deal with the imbalances, particularly the external imbalance. And that's why, particularly outside of China, we see lots of people calling for the renminbi to appreciate. I think within China, the views are a bit more mixed. There's some people who would like an exchange rate, a stronger exchange rate, not just from a rebalancing perspective, but also they see it politically as kind of a sign of a strong country. And also if they want to encourage more of their trading partners to hold renminbi assets, to make use of the renminbi, it's helpful to have an exchange rate that's appreciating. But I think there's also plenty of people in China who would caution that renminbi appreciation would essentially have quite a negative effect on China's export performance and overall economic performance. And I think that's certainly true. And I think that's a view that seems to be held to some degree by the central bank as well, based on their intervention in recent months. For example, now that the renminbi has started to appreciate again, we've seen efforts from the central bank to limit the pace of that appreciation. And just today, they removed reserve requirements on FX forwards as a tool to try and do that. So clearly, there are limits to how much the authorities currently want to embrace appreciation. And that's a problem, because if you look at the currency against the dollar, yes, it looks fairly strong, the strongest in at least a couple of years. But in trade-weighted terms, it's actually still very weak, still weaker than it was ahead of Liberation Day. And particularly in real trade-weighted terms, so once you account for the deflation that we're seeing in China, China's exchange rate is extremely weak. And in fact, that's the key reason why the current account balance and the trade balance have risen so much in recent years. It's because the exchange rate is not appreciating in nominal terms to offset the inflation differentials between China and the rest of the world. And unfortunately, given our views that overcapacity is likely to persist, at least in the near term, at least for the next couple of years, it seems likely that we'll continue to have this downwards pressure on the real effective exchange rate. And it's not clear to me that the Chinese authorities will fully offset that by allowing the nominal exchange rate to appreciate.
Neil, what is the risk here that this all ends in tears? I mean, we talked about how the current account surplus is, it's not at GFC levels, but in the neighborhood perhaps of that. Is there a risk that something breaks here if China doesn't move quickly enough to resolve these imbalances, if global imbalances are allowed to fester the way they are?
Yes, I think there is a risk. If something's unsustainable, then it can't last. I think the question is, for how long can these imbalances continue to build? The answer probably is that for quite a long time, if you look through history. Now, if you think through the triggers of what might cause a kind of abrupt and more painful correction in the absence of a correction in China's surplus, what might cause a correction in these imbalances, it comes through the deficit countries. And in particular, a sudden stop in capital flows to those countries such that it chokes off demand and therefore imports in those countries causes the deficits to close, but also at the expense of unemployment. So you would need to see, I think, in the short term, by which I mean the next year or so, a loss of faith in the dollar, a loss of faith in foreign investors in the US, and perhaps a less willingness by China to recycle its surpluses into dollar-denominated securities and assets in order for that to force a more rapid and painful adjustment in these imbalances and for something more serious to play out as a result of these imbalances. Now, at this stage, I don't see that on the horizon. If you look at behavior in bond markets, it doesn't look like there's a loss of faith in the US. Actually, yields have been falling. Obviously, the dollar's weakened over the past 12 months, but it still remains relatively strong by historic standards and perhaps a bit strong relative to traditional valuation measures. So for all the kind of rhetoric around the kind of diminution of the dollar, a loss of faith in the dollar, a loss of faith in the US, I don't see much evidence of it actually playing through in markets at this stage. So, yes, you're right, it could play out in a much more destabilizing way, but it would need foreign investors to have a loss of confidence in the dollar in the US. And at this stage, I don't see much evidence of that happening. It's a risk, it could happen, but I don't see it happening right now.
So that was Neil Shearing and Julian Evans-Pritchard on imbalances, China's domestic ones and how they are feeding global ones. Just to reiterate, the NPC opens on Thursday morning, Beijing time, and Julian and the team will be providing coverage through the day with rapid responses, and then they're going to follow up with more in-depth insight as the contours of the 5-year plan come into view. Then on Friday, 6th of March at 4 p.m. Beijing time, that's 8 a.m. London, the China team will be doing a drop-in, that's one of our short-form online briefings, to discuss what came out of that first day and answer your questions. If you want to join that session, if you're not already getting our global macro and market coverage, drop us a line at podcast@capitaleconomics.com and we can see about setting you up with trial access ahead of the NPC opening. We talked about overcapacity in China, and you can now measure how the government is making progress on tackling this with our new overcapacity index. The index was launched this past week. It basically shows that for all the talk about dealing with price wars and unfair competition and the like, overcapacity is only getting worse. That's reflected at the macroeconomic level, but you can also use the indicator to look at how overcapacity compares across different industrial sectors. I'll link to a note about the indicator and what it shows about overcapacity in the podcast notes. We've also got a drop-in on Tuesday, 3rd of March, just after Rachel Reeves' spring statement. The Treasury has been briefing that this is going to be a deliberately boring fiscal event, but to the extent the Chancellor has any headroom, and in the wake of that bruising by-election defeat for the Labour Party, maybe she'll announce some kind of giveaway for voters. Either way, the UK team is going to be online just after Reeves has spoken in the House of Commons to answer your questions. I'll put details of that drop-in the podcast notes as well. US non-farm payrolls is the big macro release for the coming week. It's on Friday, and Neil is going to be back on this show to talk about what it means for the macro and policy outlook. But do look out for our US team's preview and their reaction to the employment report. They've penciled in an 80,000 gain in jobs and the unemployment rate to tick up to 4.4%. But there is a lot of noise around this report at the moment, so you're going to want to see the team's analysis. I'll add their preview to the podcast notes as well. Now, two bits of news caught my eye this week. The New York Times reporting that Hershey's has dropped the phrase milk chocolate from some of its Reese's products, and Mr. Reese's grandson isn't happy about that. And the BBC reporting that UK supermarkets are increasingly putting chocolate bars in security boxes to prevent theft. Both stories reflect the surge in cocoa prices in recent years. But that's old news, as Megan Fisher, an economist on our commodities desk, explains in this chat. She was warning when prices were surging back in 2024 that this was all going to be unsustainable. Sure enough, they collapsed. They were still falling earlier this week when I spoke to her. And it's a conversation that begins with Megan giving a brief history of the rise and fall of the cocoa price boom.
Yes, so cocoa prices really went stratospheric in 2024 and 2025 in a way that we'd never seen before. At the start of 2023, prices were around $2,600 per ton, which is around about their long-run average. But prices rallied from there, peaking in December of 2024 at over $12,000 per ton. There's been a few reasons for this. It was mostly caused by poor supply from Ghana and Cote d'Ivoire, which together account for about 60% of global cocoa production. Unfavorable weather conditions contributed to the spread of disease, such as black pod disease, and there were some disruptions to fertilizer access as well off the back of the Russia-Ukraine war. Droughts later continued to strangle production in 2024, and combined, these factors resulted in historically large market deficits, which sent the prices soaring.
Okay, so we had this massive run-up in prices, nearly $12,000 a ton from $2,600 on average.
Yeah.
What happened next?
Yeah, so prices have really come back down. So at the end of December 2025, they were over 46% lower. But since then, that drastic pullback has really continued. So prices have plummeted to a 33-month low of just under $3,000 per ton, a lot of threes. And this pullback is really continuing. This month alone, prices are another 30% lower. And that's on news that stocks in major cocoa producers were ample, and as markets continue to expect a sizable global surplus for the next two upcoming seasons as well.
The basic laws of economics have kicked in, right? Supply has caught up, and we've now reached a point where there's a glut of supply, and presume that gets worked through. I want to just go back, though, to where prices were surging, because we saw in sort of early, mid-2024, a lot of analysts saying, welcome to the new normal of permanently high cocoa prices. So how far are prices going to fall? You said now they're below 3,000, but also to what extent has this episode, this rise and fall, this surge and collapse of cocoa prices, has that left any scarring on the market? Has it permanently changed behaviors?
Yeah, it's a great question. There's been several structural headwinds that have kept cocoa prices high and that we think might keep them from falling further, notably poor incentives for cocoa farmers in West Africa, including most recently, there's been a cut to the farm gate price, which is the price paid by the Central Cocoa Board to cocoa farmers in Ghana, and also disruptions about farmers receiving their pay on time as well. Not only does this threaten the livelihoods of cocoa farmers, but also it reduces the incentives for farmers to get into the industry and start growing cocoa in upcoming seasons as well. So we could definitely see some knock-on effects from that. Especially as lower cocoa prices in general might reduce the appeal to plant cocoa over other crops in the upcoming seasons. At the same time, for a long time now, aging cocoa trees, especially in West Africa, have found that they have reduced resilience and disease resistance. And this makes them more prone to sudden supply shocks, which is, again, what we saw back in 2023 and 2024. The spread of disease really ravaged those aging trees in West Africa. Similarly, as we look forward from here, climate change and the growing incidences of adverse weather events and natural disasters could have some potential to disrupt upcoming seasons of cocoa supply without much warning. Again, that was a trigger back in 2023 as well. So that's only likely to become more frequent. So bringing all that together, it's not likely, in our opinion, that cocoa prices will fall all the way back to their long-run average, which, as we mentioned before, was around $2,600 per ton. They actually have some scope to remain a bit elevated from here, perhaps more in the window of $2,600 to $3,000 per ton, with obviously risks to the upside of another sudden supply shock as well. I'll say it's not all doom and gloom, though. High cocoa prices over the past few years have incentivized greater production from Latin American producers such as Ecuador, which is on track to overtake Ghana as the world's second largest cocoa producer over the coming years. And the benefit to this is that Latin American cocoa plantations benefit from having younger and more resistant and higher yielding trees, and better farming techniques as well. So that's something that's going to change the outlook for the market going forward. And on a global scale, diversifying the location of production across continents does reduce some of that impact of regional specific shocks on prices, such as from weather events, for example.
So this whole boom and bust episode for prices, what was the role of speculation in driving it up and down?
Yeah, so in the very early months of the cocoa rally towards the start of 2024, speculative activity, which we determined by looking at the open interest in cocoa futures, was very high, which exemplified those gains in prices. But what we saw throughout 2025 is speculative activity really falling off to a historical low by the end of the year. So as prices became very high, I think investors got a little bit worried about how sustainable that was, and they started jumping out of cocoa futures. But what's interesting to note now, though, is recently the low prices seem to have been driving a little bit of an uptick in open interest again. So we've seen investors showing a bit of interest in coming back into cocoa futures, especially since the start of this year. So the implication of that is that cocoa might become a bit more vulnerable to those speculative swings in prices from here on out as well, especially if there's any news of a negative supply shock, for example, which is what happened back at the end of 2023.
Talk a bit more about demand destruction, could you?
Yeah, so demand destruction is something that, while the scale of the rise in cocoa prices was particularly unexpected, I think, for all of us, we did warn back in 2023 that cocoa prices rising to such levels was quite unsustainable. And what we've really seen is that high cocoa prices, as they've been passed through to consumers of final products, for example, those of us enjoying chocolate, these high prices have really disincentivized buying and really damaged demand across key consuming regions, for example, Europe, which is the largest cocoa consumer. So in all, in 2025, demand for cocoa was 6% lower in 2025 than it was in 2024. And this was even more drastic for Asia as well, where demand was 9% lower in Asia in 2025 than in 2024. So we have seen a bit of a trend of cocoa being removed and replaced with other commodities, for example, palm oil and sugar as well. Sugar prices are at multi-year lows. And I think replacing some cocoa for sugar is something that could continue for quite some time. But what's interesting is we might see a bit of reversal of this as cocoa prices tumble lower. And palm oil prices are actually quite strong, particularly due to high biodiesel demand from Indonesia, for example, which threatened to remove the amount of palm oil available for export last year. And as crude oil prices remain a little bit higher, it puts upward pressure on vegetable oil prices due to their use in biofuels as well. So therefore, the products typically replacing cocoa within chocolate might also be becoming more expensive themselves. So we could see a reversal of that trend.
I guess the key question for chocoholics like me everywhere, what does this mean for chocolate prices?
Yeah, so as for the price of chocolate on shelves, it will be interesting to see to what extent chocolate manufacturers and retailers pass down this fall that we've seen in cocoa prices. Chocolate companies often buy their cocoa up to 12 months in advance of bars hitting the shelves. So the largest drop-off in cocoa prices might still be to feed through into lower chocolate prices. And based on our analysis, we think that could be around Q3 of this year in the UK, at least. At the same time, as I mentioned, we've seen prices of other key ingredients in chocolate have also been falling, so that should help as well. But again, it really remains to be seen whether this unprecedented rise in cocoa prices has permanently dislodged the relationship between cocoa and chocolate prices, or if manufacturers are even willing to pass on these costs. But yeah, the kind of working assumption we have is that lower chocolate prices are coming towards the end of the year, which is great news for all of us, I'm sure.
Something to look forward to. I mean, is there anything in this episode that it's not the first time we've seen sort of massive boom and bust, although this has been, as you said, quite extraordinary. But is there anything from what's been happening in cocoa that we're seeing elsewhere in soft commodities, or any lessons that can be drawn from all of this?
Well, not quite as dramatic as the cocoa rally, but we did see coffee prices also surge at the same time in 2025. Poor production numbers in the 2024 season and historically low stocks in warehouses pushed up the prices of both varieties, Arabica and Robusta, to a peak in February of 2025. For context, that pushed those prices up to 3 times higher than their levels in 2020. Now, due to expectations for very strong production in top global producers, for example, Brazil and Vietnam, global prices have tumbled and stocks are also improving. So we see that both the prices of both varieties are now about 35% below that February 2025 peak. Perhaps the main difference to cocoa here, though, is that coffee demand is quite resilient. It's probably what we would refer to as a necessary good. I'm sure most of you would agree. So the good news is that the easing prices in the raw coffee beans are starting to show some signs of softening retail coffee prices as well, particularly in the US, where prices were very strong. The larger falls of this, we think, will take place towards the second half of this year. But that said, you're right to say that coffee and a lot of soft commodities face some of those similar structural risks to cocoa. The risks of more and frequently adverse weather conditions and still low numbers of stocks, given the previous rally, could mean the prices are more volatile than before. And broadening this out, with the exception of some of the more resilient growing methods in Latin American producers, climate and weather risks is going to be a very key theme across all soft commodities going forward. And it also remains to be seen what the impact of the EU's deforestation regulation might be. So this affects coffee, cocoa, soybeans, palm oil, and other soft commodities. For context, this puts the onus on exporters of soft commodities to prove that commodity originated from a region of no deforestation before it can enter into the EU. So this could open up some instances of two-tier markets in soft commodities, for example, where EU-compliant commodities would trade at a premium to non-compliant. Currently, the EU deforestation regulation is slated to come in December 2026, although it has been delayed multiple times, which has been a bit of a frustration for exporters and importers alike. So that's a key thing to watch going forward towards the end of this year as well.
Megan Fisher on the cocoa price boom and bust and why chocolate prices might get a bit cheaper. Here's hoping. But that's it for this week. We will be back next week with the latest on US unemployment, what the Chinese leadership actually announced at the NPC, and much, much more. Until then, goodbye